everyone. Thank you for attending our Family Foundation webinar. I think this is the second in the series from our company. And if you're interested, you can also go back to listen to the first one too. The one thing is there's an unfortunate thing. We had two guest speakers, Philip and Byron, and they're both my clients, and they have set up their family foundation with us. But due to travel arrangements, kind of a last minute travel arrangements, they couldn't attend this webinar. But guess what? I have someone else here that's, I won't say that's better, right? But it's as good, okay? So today the webinar will be presented by me. I am the CEO of the Zoe Agency and one of our senior accountants, Jacob. I think most of you know me because I think most of you are my clients. If you're not, I am, I guess, a self-made CPA that provides a lot of good tax strategies for people over the last 30 years. And Jacob, maybe you can also give us a short bio of yourself.
Yeah. So my short bio is I am I'll start off when I joined the firm. So I joined Zoe Agency here about 3-4 months ago. Really been enjoying it and everything like that. But I do have a lot of tax background aside from here. So I'm a dedicated tax professional with a service-oriented approach to handling clients. I have experience spanning from financial planning and tax preparation all the way up to very complex tax strategies for billion-dollar family offices. In my free time, I have, I've been in your position, actually. I've been looking at starting a 501c3, a non-for-profit, and I sat on a board of a non-for-profit as well. And I do enjoy exploring business processes.
Great. I told you before, right, Jacob? You are the homegrown, good Midwestern boy.
Well, thank you.
Welcome to the team, and we are going to ask Jacob to ask me questions to make this presentation more interactive and more interesting for all of you. First of all, a little marketing, I guess, elevator speech of our firm. Zoe Agency is not just a tax preparation firm. So, our core competence is in tax efficient wealth accumulation and also in execute some of the strategies and solutions for both high income, high net worth individuals and small businesses across the US. We do have 3 branches: tax, real estate, and insurance. Without further ado, let's start the webinar on Family Foundation.
So, Justine, we kind of talked about family foundations before in our previous webinars and all that, but how do you save tax through a family foundation?
Yeah, so family foundation is definitely a really, really effective tax saving tools. So I put it in 3 different perspectives. When you first donate money to your family foundations, almost like donate to the Red Cross, right? It's a non-for-profit organization. So you get an income tax deduction. I'll give you an example. Jacob, if you live in California and you make $1 million, what is your marginal tax bracket?
Well, so you're at 37% federal. And then on top of that, you also have the state taxes, which, in California, you're talking near 10%. And then also the net investment tax as well. So you are over 50% in some situations.
Yes. So every dollar you contribute to your family foundation, you get 50% of income tax deduction. That's huge, right?
Yeah. Wow.
So that's the first thing. That's why it saves a lot of tax. And the Uncle Sam led you to save so much tax because the money will be going into a private foundation that will contribute to the society. That is why Uncle Sam is most generous. Most of the states also allow the deduction, right? Only a couple of Midwestern states don't, right? Which unfortunately, we are living in one of them, Illinois.
Yeah.
That's why we have a lot of clients from California and New York do this. They also have higher income to save tax on. So the second perspective is after you transfer your asset to the foundation, the asset can grow tax-free. Because it's a non-for-profit organization, if your assets grow because of your good management, you invest in some good stocks or even crypto, right? the gross, you never have to pay tax again. You only have to pay an exercise tax, which is 1.39%. Compared to what's the long-term capital gain tax, Jacob?
Upwards of 20,
Yeah,
23, I
plus
believe.
the 3.8. I always say that, 23.8, right? Plus the state, it's 35%. So now it's 1.39%. That's the tax-free gross of the asset. And the last part, let's not forget, because you transfer the assets to the family foundation, you don't have to worry about estate tax because it's no longer yours, though you control the asset, right? So what is the estate tax rate, Jacob? I'm going to test you.
Well, so what? It's 40% federally, and then states on top of that. And
Mhm.
there is an exclusion amount, obviously. But on the state side, that's a lot smaller, the exclusion. So state by state, it can range much more than 50%.
You're right. You're right. So if we talk about the federal only, right, it's 40%. And it goes up to 40% really quickly. The climb up, not like income tax, right? The climb up is really, really fast. So imagine that, guys. You're paying 50% when you make money, and you're paying 35% when your asset is making money, right? Because you're good at investment. And then you're paying another 50% after your exemption to Uncle Sam. So all your life, you're paying tax. That's why I always tell my clients, tax planning, saving tax, is not just today, is your entire life. And that's why Family Foundation is a great tool. So you're saving tax in 3 different ways. All right.
One small point of clarity that I do want to make is us Midwesterners still can do this family foundation. We just can't get the state income tax deduction on it for like Illinois, but we would still get the federal income tax deduction.
Okay, thank you for the clarification. We do have clients from Chicago too, because we are a Chicago firm. Yeah.
Yes.
I mean, 40% is still a really, really good, what you call tax saving, right? And what, the tax bracket or tax rate is going to go up in the future, right? Just imagine that. I remember when Bill Gates donated to his foundation, the marginal tax rate is much higher than today. All right, let's go to the next topic, right?
So this next topic is what assets can we donate to the foundation?
Yeah, you can pretty much donate everything. Cash, definitely you can put cash there. You can also transfer your real estate, your red wine, whatever, right? Your crypto. You can transfer any assets to your foundation. But the one that I tell people that has the double tax saving, besides that 3 other ways save tax, is the long-term held appreciated stock. So I had clients who bought Apple stock like 30 years ago. Imagine that. So let's say you bought the Apple stock at $10 and now it's worth $1,000. I'm definitely wrong. You probably know how much Apple stock worth now.
Well, there's been a couple stock splits in there and that kind of stuff too.
Yeah. So let's say you own a stock that you bought it for $10 and now it's worth $100. I'm not going to be dramatic, okay? And if you sell the stock, you got to pay the long-term capital gain, right? But if you transfer that stock to your foundation, you get an income tax deduction of $100 instead of the $10 basis. And then you did not realize that capital gain tax. So you're saving capital gain tax and income tax. So you're saving 2 taxes when you donate. That's why long-term held appreciated stock is the best asset to donate. We actually had Byron, who did the first one with us. This year, I think he donated over $1 million of appreciated stocks to his foundation, and his basis was less than half of that. Imagine that. So he saved the $500,000 first in capital gain taxes, and then he's also saving the $1 million on the income tax. So he's saving $1.5 million income tax of the income. Isn't that great, Jacob?
Yeah, that's extremely significant.
Yeah. So, I mean, when I'm talking about this, I may step back a little bit. People are like, oh, yeah, you're telling me you're saving tax, but still, even if I'm saving 50% of tax, I have to put up another 50% to my family foundation. So that's why I say family foundation is only the right strategy for you if you also want to be a philanthropist, right? Is that correct?
Yeah, philanthropy.
Yeah, so it has to be dual purpose. It's not just for tax planning. If you want to contribute to the society, you want to make a bigger impact with your money, then I think family foundation is a really good tool for you. But I think sometimes as a CPA, I focus way too much on just the tax saving instead of all the good things you're doing for the society. You got to have that too. So it's a dual purpose vehicle. And the long-term held appreciate stock is a really, really good asset class to put into the foundation because you also avoided the capital gain tax. So when I had this conversation with clients, I sometimes get different feedback. Some people are like, I don't really want to sell it. You don't need to sell it, right? You can move it to the foundation and not selling it. You are going to get the market value of that stock as an income tax deduction. Also, there are people who say, hey, I really want to sell my stock because, I have so many stocks from the company I work for. Now, 80% of my asset is in my company stock. But if I sell them, I'm going to pay so much tax. For those people, this is another great solution. You don't even have to contribute cash. Just contribute some of the stocks. Make sure it makes up to 30% of your AGI. Then you can deduct that. You can save so much tax. I'll give you an example. If you make $1 million, right? And then you donate $300,000 worth of, no, I'm gonna back up. You can only donate up to 200,000 because only 20% if you contribute stock. Only when it's cash is 30%. So if you donate $200,000 worth of stock, and those stock, the basis for you may only be 20,000, right? So you donate that portion of the stock to the foundation. You don't have to sell it, or you can sell it to buy other assets to diversify, right? But meanwhile, you're going to save $100,000 in tax. So that year, when you do your tax return, you're going to get $100,000 refund. While not really putting any cash to the foundation, you're just moving your $200,000 worth of stock to the foundation. I just feel like there's so much tax saving in there that and most of my clients who are very successful, who make good money, most of them do have long-term held appreciate stocks because of either from their job or they are very good investors. They are investors that are patient, Jacob.
Yeah.
They don't just sell when it's good, right? I had a joke from my Merrill Lynch advisor, say that the account that performed the best are the dead people's account because they never do anything. That's probably a joke, but there is some truth in it. Okay, I think I talked too much. Let's move on. Hopefully people get the point of the long-term held appreciate stock is so good for you.
So one question I do get from a lot of clients is like, what's the difference between a family foundation, family trust, charitable LLC? Like, what's the difference? Why family foundation?
Very good. Yeah, this is almost a question I get asked daily. And people actually come to me to set up a family trust. First of all, I say we don't do family trust. A local lawyer has to do it for you. And they are not mutually exclusive. And the people who is setting up a family foundation, they probably need a family trust too, right? So family trust, there is two kind of. One is those revocable ones called the living trust or grantor trust, or, when it's a revocable trust, the main purpose of that is to really, to prevent the probate, right? The probate is really a very ugly machine, okay? So when I die, the state is going to decide where my stuff is going to. You don't want that. So you will have a family trust, put all your assets there, right? And then, so when I die, it will not go through the probate. So my kids, my beneficiary can get all my assets. So that's mostly the living trust, right? And also to let the people know what I want to leave to whom, if I have multiple children, right? Especially people who own real estate. And the irrevocable trust is more people to avoid or reduce their estate tax. Because the minute you put it into the irrevocable trust, it's also no longer considered as your asset. It's almost like the family foundation, but you still can control because through the trust, you can control it, right? But the thing is the family irrevocable trust, even if you can save the estate tax, there is no income tax saving. Because if you put stocks in there, when it makes money, it pays almost the highest tax bracket. Because, the estate tax, you've done a 1041, right?
Yes. Yeah.
The bracket goes up really quickly to 37%, right?
Mm-hmm.
Yeah. So you're not saving any income tax, but you're saving estate tax. Because if you're putting away, let's say Jacob is so young, I just said you're 20 years old, right? So when you put $1 million into your irrevocable trust, it can grow to 10 or 20 million when you are 60 years old, right? Mm-hmm. So all this grows, you're still paying tax, but it will not be part of your estate. So that's the main count. But the family foundation is a completely different tool. It's more for a charitable contribution. So the money goes there, will be working towards making the world a better place, contributing to the community, right? So in the way that it's no longer part of you and you never have to worry about tax. So from a tax perspective, this is better. But I cannot say it's just the only thing you need to do. You probably need to do all of them, but for different purposes.
Yeah.
Did I make it clear, Jacob?
Yeah, I believe so.
Okay. All right. So I think we are kind of done with I just want to, from the tax saving perspective, I hope I'm, pretty thorough in covering all the aspects that how family foundation is saving you tax, saving you a lot.
All right. Well, yeah, this all sounds very, very good, but there's got to be some rules involved, right? Like what all goes into this?
Yeah. So I think our first webinar talked a lot about how family foundation saving tax. That's why I was not very detailed in the first part. And anyone have questions, you can always reach out to us. And if you are already our clients, make sure schedule a tax planning session with us. We can go deep on the subject. So today, I also want to spend some time on when you're actually operating a family foundation, what are the couple of things you really need to know? And sometimes I feel it's really good for people who have not started the foundation to know these things so you don't walk into trap, right? The first one I want to touch upon is the 5% spend down rule. So Jacob probably found this for me. So that's the Internal Revenue Code. You can, all the audiences, if you want, you can read it, but don't go to sleep reading it, okay? What I want to tell you is from the real life experiences, I have so many questions about the 5% spend down rule, right? So today I want to focus on two things. One is 5% of what? There's so many confusions on that. And the second is what are these 5% can be spent on? So first question is what?
Yeah, how do we calculate this base for the 5%?
Yeah. How do you calculate? So some people think it's 5% of their contribution. Some people think it's 5% of the gross of their contribution, like all kinds of stuff. So the definition is really, these are two steps to calculate the 5% basis. One is you have to determine the fair market value of the foundation's non-charitable use assets. So if you contributed $1 million to your foundation, and then you bought $1 million in stocks, so your fair market value is $1 million, right?
Yeah.
That's very clear. And then if you contributed on December 31st, your average asset is not $1 million. It's $1 million divided by 12, which is 80,000, 85,000, something like that. No. Yeah, 85,000 about. Yeah. It's not 100% correct. Yeah. So then it's 5% of that. That's your first year. And if you contribute $1 million to your foundation this year, which is 2024, the 5% of the $80,000, which was $4,000, you have to spend down in 2025. So guys, they give you a lot of leeway, right? It's not just you have to spend it this year, it's the next year. So the calculation is very, very important here. Also, if you have something is for charitable use, let's say you contribute $1 million to your foundation and you bought a piece of land for $1 million for bird sanctuary. One of my clients is going to do that. They want to buy a huge piece of land and to let bird to stay there, right? I mean, for the environment. So if you do that, the whole $1 million you already spent for charitable purposes. So there is no more spending down because people are like, then what? I don't have money to spend down. You already basically donated $1 million to that cause. So it's a non-charitable cost. You can also subtract any of the associated debt or taxes paid on your investment income. That's pretty straightforward. And then you multiply that by 5. So I hope it's clear here, Jacob. You have any questions? Did I make it very clear to you?
Well, yeah, it's clear, but this seems like a lot. Are clients supposed to be doing this on an Excel sheet, or how will they know this 5% number?
Oh, very, very good. So people come to us to do tax, right?
Mhm.
So 2024 tax is due what? 2025, May 15th, and you can extend to November 15th. So we're actually very busy doing foundation taxes right now. So this is the time we are calculating their 2024 basis. And then after we calculate it, we'll tell them by the end of 2025, you will need to spend down this much. So do you have time? Yes, you do it. You don't have to do any work, Jacob. We're doing your work.
Oh, that's great. That's good. And it's
Yeah, you
nice
better
that we're
let us
not
do
giving
your
them
work.
like a
Yeah,
month,
yeah, yeah.
like they have an entire full year to disperse this funds to whatever charity or however they see fit.
Yeah. And then most people by this time, when we're doing their 2024 tax return, they've already spent some money, contribute some money to charity. So we just have to fine tune, make sure they get to the number. And more than half of our foundation clients spend more than that. Spend down, not spend. That's a wrong one. Spend down include both spend and contribution, right? Donation to other causes. So altogether, so this is not really a big issue to be worried about.
Got it.
And I'm gonna quiz you, Jacob.
All right, let's hear it.
If you don't do the 5%, let's say by the end of 2025, you still didn't spend down the 5%, then what happened?
There's a penalty.
Yes.
That penalty is 30% of what you didn't spend down.
Yeah, it's a huge penalty, isn't it?
Yeah. So if you didn't spend down or donate that, let's say it's $10,000, you're looking at a $3,000 fine or penalty. So this is not something you kind of want to play around with. It's something that will get off the tax return for you and convey that to you very straightforward.
Yeah. So you really need to come to us to do your tax return because a foundation tax return is pretty complicated. It's not just a profit and loss kind of thing. It's more like a balance sheet thing. And the balance sheet calculation is very tricky. I do not know what happened. Is your robot in there, Jacob?
A robot?
I saw two Jacobs on the screen.
Oh yeah. Nope, just me.
Just you. Okay. I don't know what happened. Okay. Anyway, I think we beat down on the basis. And the second topic I want to talk about is what is qualified distribution in that 5%, right? So certainly you can give to Red Cross. But the whole point is you don't want to just give it to Red Cross. Otherwise, you're not going to have a family foundation, right? The reason you have a family foundation is you have control and you can make it into a bigger, make good investment decisions and make a bigger impact, right? So the first one, and then remember all the administrative expense. You think the money people pay us to set up the account, set up the foundation and do the tax is deductible, Jacob?
Yeah,
most definitely.
That's all part
some of the travel expenses, so all these will be considered into your 5%, pretty broad, but don't forget the reasonable and necessary. This is where I have a lot of conversations with my clients. Let's just be real. So what is the purpose of this activity? To spend the money or to contribute to the society, right? So if the purpose has to be contribute to the society, the necessary expense can be, can be deducted. And then you also can pay people to do the work for you, right? So it's almost like running a business. I still remember Bill Gates said that the reason I'm doing a Bill Gates Foundation is it's actually Bill and Melinda Gates, right? I want to run this foundation better than Uncle Sam, more efficient because I'm running it like a business. Yeah, so I'm not going to read it all, but I want people to understand that it's a very broad scope of what you can use to qualify the 5% spend down.
Yeah, so could we if I hire employees through the foundation, is that part of the 5% spend down?
Yeah. If you hire the employees to let's say set up your website, your logo, right? And maybe some of the foundations even have an office. Don't know, whatever is reasonable and necessary.
What about my personal credit card bills? Can I pay those?
Are you kidding me, Jacob? I know that's a joke. Yeah. That's definitely a no-no. So here comes, when I have small business owners, I tell them always not to commingle the funds, right? If you commingle personal and business funds, what happens?
You pierce the corporate veil.
Thank you. But if you do the commingling in the foundation, what happens, Jacob?
You pierce the foundation veil.
You're gonna lose the tax-free status.
Yes.
That's a huge deal for you. Don't ever do that. So I would tell all my foundation clients, you have to be very serious with your spending and keep good records, with all your spendings, right? Got to be serious about this. Okay. I think we're pretty straightforward on this 5% rule, right?
Yeah.
Yeah. But sure, there are still a lot of questions. I have a lot of questions from people. That's why we provide the service. We don't just set you up and then you cannot talk to anyone. You're going to talk to us. We also offer annual package services for all the foundations that you can ask us unlimited questions. I think the next thing we're going to touch is the self-dealing rule. That is also a rule like a lot of clients keep asking me. So what's considered a self-dealing? I have clients ask me, can I pay rent with the foundation? Pay my rent with the foundation. What do you think, Jacob?
Nope, just like the credit card bills. It's co-mingling. You don't want to do it.
Yeah. So I guess this, again, it's an IRS definition. So make sure you understand what's disqualified person, what's prohibited transaction, right? Basically, you cannot do business with yourself. And foundation itself cannot do business. It's not a for-profit, right? You can invest. Let's say Jacob is starting a mortgage company tomorrow, and I believe in Jacob, and I have a Zoe Foundation. I can definitely invest in Jacob's the mortgage company, right? Mm-hmm. Because that's an investment. But I cannot go there as a foundation to run the business with Jacob.
Yes.
Right, and I cannot own a certain percentage of the ownership because I should not have a voting power. Mm-hmm. Because I'm just investing. Okay, I'm an investor and it's a silent investor. So it's very, very important. And the disqualified person is a very long, extended list, right, Jacob?
Yeah.
Basically, the family member, you can tell us a little bit about the family member definition. It's very broad, guys.
Yeah, we looked into it and it basically covers anybody who is related to you, and it even goes into your ex-spouse and that kind of stuff. So it is like you just don't want to deal to your own family. Which is, I mean, the whole point of this is not to enrich yourself and your family. It is to give back, though, too.
Yeah. So the thing is, I always say this. If people ask me, hey, can I set this foundation, put the money there, and you give me strategy how to just take it out for myself, I always tell them this is not a good strategy for you. There are other tax saving strategies out there. So you do have to want to contribute to the society. You want to make the world better, like I said, right? Meanwhile, you want to save tax. And you always have to remember why this one is such an effective tool to save tax, because it's for charitable purposes. But does that mean that you cannot control the money? It's almost so you will say, why don't I just give it to Red Cross, right, Jacob? Mm-hmm. I can tell you one thing, like I think Bill Gates' kids, all 4 kids or 3 kids, I forgot, they all work for the Bill Gates Foundation and their income are over $1 million. So is this self-dealing, Jacob?
No, they're doing a job and they're getting paid a fair rate for it.
Yeah. Because if they are working for other non-for-profit organizations, they will get paid that much too. Mm-hmm. So they are getting a reasonable compensation. So people, we have to remember, paying yourself a reasonable, salary or whatever. Yeah, that's not self-dealing, because you're actually giving, you're making contribution. I can give you, Byron's not here, but he's probably listening. So Byron and Kathleen, his wife, has become full-time philanthropist this year. Good for them. I really miss them that they couldn't come today. They are currently in Hong Kong. So they are going to pay themselves a reasonable wages starting next year and doing house insurance because, they're no longer working. They're still very young. So, all these health insurance benefits, it's all reasonable, right? Mm-hmm. It's not being crazy, and even retirement plan. So these are the things. I'm not saying that you are taking money for yourself, because I'm sure Byron and Catherine can go out and find jobs that will pay them much more than what their foundation will pay them. But that's not what they want to do. They want to make their foundation a real good tool to help the society, right? So that's self-dealing. Go ahead, Jacob.
How do we kind of figure out what is fair then? Is there a way to look this up? Is it stated on the IRS website? How does this go?
So whenever the IRS say reasonable, right, you just have to come up with how you come up with the number, right? Mm-hmm. So let's say Byron used to work for a consulting firm making $300,000-$400,000, and now he's working for the foundation, paying himself, let's say, $30,000. Is that reasonable?
No, you should probably be paying himself more.
Yeah, but I mean, lower is okay, right? But if he's
Yeah.
paying him, let's say if he's paying himself also $300,000 and his foundation only have $1 million assets, you think it's reasonable?
No, it all depends on the size of
See?
the foundation, then the work they're doing.
Yes. So reasonable has 2 points. One, reasonable is what's your skill set. One is how much you're really doing in the foundation, right? Bill Gates Foundation has the asset of what? I don't know, billions, right?
Yeah.
So that's the whole point, right? And they have private jets, right? Why they need it? They fly to Africa. They really need it, right?
Mm-hmm.
So that's the whole point of it. So you really have to understand that reasonable thing. And the self-dealing is prohibited, but paying yourself a reasonable wage is not self-dealing.
Got it.
But you cannot rent your own investment property to your foundation for office. That's self-dealing. That's a lot of questions to clients talk to us.
So there's a lot of pros with this. Is this just like a one-time setup thing and we're done? Just set it and forget it and we're all set? Or is there some sort of annual filing and like what all goes into it going into the future?
So to really effectively run a really good family foundation is definitely not a one-time thing, right? After we set up, we have to annually do a federal tax filing, just like yourself, your business. And like I said, it's a very complicated form. You also have to file an annual report with the state. And some states have additional filings with the Attorney General's office and other like biannual filings. So just not that complicated, but every state is different. So you need to know in your state what's needed. You come to us, we'll figure out for you, and we're not getting any penalty. That's the whole point. The compliance part is very, very important. And I don't know whether TurboTax has 990, Jacob. Did you research on that?
I didn't do too much, but I don't think it will do the family foundation. It might have 990 easies for the very, very small like public organizations, but I do not think that it's a good idea. Even if they do allow it, I don't think it's a good idea to try to, flail your way through this. What would you say is our like success rate with setting up these family foundations in the past?
Oh, our firm, it's 100%.
100%. Wow.
Yes. Everyone who engaged us to set up their family foundation, it's 100% success ratio. Yeah. So I think how to put it this way, 990, I don't know how many pages, it's multiple pages. It's a lot of things. And also the balance sheet part, how to really calculate your fair market value of your asset, especially when your investment are complicated. It's just not a simple task.
Yeah, I don't think an average person would have 100% success rate. This is something that you would probably want to leave up to a professional.
Yeah. And you never ever want to lose your whatever free the 501c3 status, right? We actually I'm no longer. I was on a board of a small public charity, and they forgot to file their tax return for the last 5 years. So they got a letter from Uncle Sam. Uncle Sam is pretty slow, but they got that letter. So they wanted to reinstate and they couldn't. So we're actually doing our firm is doing a pro bono for them to basically reapply. It's a lot of headache. Mm-hmm.
Yeah.
And the 990 easy is for any foundation or any organization has less than $50,000 in assets, right?
Yeah. So that's the very small local charities. This is not something that you use for a family foundation.
Yeah. Okay. All
right, Justine. So how do you how do you use a family foundation to create a long-lasting family legacy for your kids and your grandkids?
Yeah, very good question. This is really what I want to touch upon. I also learned a lot from all my clients. I'm inspired by them. From having a family foundation, like I said earlier, right? It's to contribute to the community and to save tax. This is also a really good thing for your family because I have a lot of clients have younger children, teenager children. So as a family, you also have kind of a core value. You instill that value into your kids when they're very young. And the family has a purpose, right? I mean, sometimes we joke, right? When this is also Bill Gates said that I don't want to give my children too much money that they cannot work. Mm-hmm. Because when money is no longer an issue or no longer a burden for you, what do you want your kids to do, right? And I think the ability to give is a blessing. And if you instill that value really young into your kids and you do things together to help other people, you will make them much happier. So we have a client recently told me something very inspiring. He said, you have money, right? You can always buy a bigger car, bigger house, an airplane, a boat. There's no end of it, right? He lives in California. He said, I'm living in a $2 million house. I can buy a $5 million or $10 million house. But is that the best use of my money? Or is that the best way for me, for my happiness? His answer is no. He wants to make a bigger impact. So he made his choice, right? And it's so cool. He can instill that into their children too. No judgment here. Otherwise, nobody's buying the $10 million house, right?
Yeah.
We still need them. The economy still need them. But I'm saying is you have to figure out what you want to do. If you already feel like this kind of money, and I have clients come to me, are not at the highest tax bracket. They still want to do this because for them, the ability to run this is giving them so much energy. If we do something we love, the passion, right? That's not money can buy. So what I'm saying, so you can definitely make this into a family legacy, and you can involve them early. They can help you with things. You can pay them, right? Also make them understand the, work ethics, not just paying them to save tax. You're paying them, it's good. They can have a Roth IRA, Jacob, right? When Tio can have a Roth IRA.
Yeah, for those of you who don't know, I just had a baby, so we are trying to get him some earned income in here, so he can't Roth.
So Jacob, your baby is very cute. Maybe he can be the model of your foundation.
Yes.
Yeah, and then you can pay him, $7,000 and do it your kids' Roth IRA, right?
Yep, yeah, most definitely.
Imagine if you start him when he's 1 month, how much money he's gonna have when he's 60.
I have nowhere close to enough assets yet, but give me another 30 years, and when I'm in your situation, we can.
Yeah, and another beautiful thing is, like I said, it's not subject to estate tax, and the foundation is run by a board of directors, right? So some of my clients have them two, the husband and wife, and 2 children as the board of directors. If the children are too small, later on they can be voted to be the board of directors. And again, this is a private foundation. You get to decide all these things, right? Nobody's telling you what to do. And then that's how you achieve perpetuity. Is that how you say it?
Yeah.
Perpetuity?
Yeah, perpetuity. Yeah,
perpetuity. My English is really off today. So, your whole family's legacy can go on. This is, to me, is the most beautiful part of family foundation.
Oh yeah, most definitely. And like some personal experience I've seen working in like family offices and stuff like that. The people that keep their family together and continue to build business or go after that non-for-profit goal are a lot closer than maybe some of these like 5th generation trust fund kids that just got the money, don't really know where it came from. So it is a good way to keep the family together and keep them strong.
Yeah. And then the thing is, just always ask yourself, what makes you happy?
Yeah.
If that bigger $10 million house are going to make you happy, nobody's stopping you.
Mm-hmm.
No judgment here, right? But if you are getting to a point and say, I think this is enough for me materialistically, I'm still making money, I'm still making a good sound investment, my children are taken care of, I want to do something else. This is a great tool for you. Okay. I have 3 kids, so this is a very big topic for me. All right,
Justine. So what is the process of setting up the family foundation?
Do I want to scare you?
Yeah, scare me.
Okay, this is all the steps. Okay, I don't want to bore the audience to read this or it's all on there. So it's much more complicated than just setting up a business, for sure. And the most difficult part is to really get the approval from the IRS, right? To your 501c3 status. After doing all this, you still have to do that. Mm-hmm. You have to set up. You make all these decisions, and we do the background work for you. We set it up for you. This is. Before you set up, you need to think through all these, right?
Mm-hmm.
Yeah. Otherwise, you're going into it kind of blinded.
Yeah. Yep.
Yeah. Yeah. And I want to say one thing. The fastest one in my whole doing this family foundation career is someone only took 2 months. Last year, September 16th, he talked to me. The first time ever. September 26th, he signed the engagement letter. November 28th, we finished the whole process.
Wow.
The fastest ever. I normally tell people it drags is because of you, not because of us, because people are not clear with these things. So that's a lot we do with clients. Why he's so fast is because he thought about this concept for 2 years. So when he came to us, he was ready. He knows exactly what he wants to do and how, so we're just helping him to get it going, right? So, I mean, people also ask me, can I do it myself? Yes, you can. But hopefully you get through it correctly, because also if you want to save tax this year, you cannot fail the process, right? If you fail, then all the money you contributed will not be able to save your tax.
Yep. So that moves us on to when is a good time to apply for this? Like, could we get this going before year end?
Yeah, I just told you the fastest 2 months. So if you apply today, it should be fine.
Yeah.
No, it's not. So the whole thing is, because the steps basically there are in my head is like 3 steps. The first step is get it done, get it set up at the state level, and then you go apply for the federal exemption, right? And the last step is go back to state and get certified. So in those 3 big steps, only the first step needs to be done by December 31st.
Oh, okay.
Yeah.
Okay, so it doesn't even have to be completed. Yeah. Once we have the state registration done and they open up a bank account, they can just start making contributions?
Yes, yes.
Got it.
So the contribution has to be made by December 31st, 2024. And also, December is the month of giving, right?
Yep.
For that reason. So it's also a good time to talk to your CPA about the tax planning this year. What's your AGI? What tools you can use? Family Foundation is just one of them. There's a lot of tools. This is the time, our busiest tax planning season. So talk to your CPA, figure out what you need to do. And if you still want to do the Family Foundation, you definitely have time to do it this year. I think in my head, the latest is probably December 1st.
Okay.
By December 1st, you're like running the treadmill,
Yeah.
Because the holiday is coming, and also you have to make sure you contribute the money, right? And especially if you want to donate your appreciated stocks, which means you will have to set up a brokerage account.
Oh, yes.
Not just the bank account, right? And they have more rules. Some brokerage account company actually need you to get the 501c3 status first. Then you might not have time. But I know there are brokerage firms, big ones, that will allow you to be pending, the status to be pending. So like I said, don't wait too long. We have time, but we don't have a whole lot of time, right? I think, Christy, you can probably send everyone a link to schedule a time with Jacob in the next few days to talk about the possibilities of getting set up. You can talk to Jacob about whether it's a good strategy for your family. And, if it is, we should move it forward. If it is not, it is not. At least, you get to understand this better. Maybe not this year.
Yeah. And we can also talk about some other possibilities too, if this isn't exactly what you're looking for as well.
Yeah. We also always like to know our clients better before we actually set up for them. So we might also ask to review all your tax returns to make sure this is the right strategy for you. Yeah. So please schedule time with Jacob. And here is both our information. So if you still want to, if you are my client, you want to reach out to me directly, go ahead. The reason we're putting Jacob's calendar link is he has more slots for you guys. And I don't want you guys to wait for a week to talk to me, because we said we do have time. We don't have a lot of time. So hopefully you guys can schedule time with Jacob and we can see whether Family Foundation is the right strategy for your family. I guess we're going to the most fun part of our presentation.
Right on time too.
Yeah. Nobody would sleep in this section, I think. Yeah. Christy, are you gonna, unless we don't have any question, that would be cool. I answered all your questions before they were asked. Christy, are you going to pop the question? We have 15 minutes. I think we can do 10, maybe even 10 questions if we have that many. First of all, I told you we have 100% success ratio, so you should be okay. But even let's say the worst comes, you're just not getting the deduction, but you can move them. I'm sure you can move the money back. It never happened to us before, but if it's denied, it's no longer a charitable contribution, the money should not be stuck. That's a good question, Suraj, but have confidence in us. And the whole thing is you need to work with us. A lot of times the longest foundation, I think almost took a year. I think we started October, finished next year in October. The main reason is the clients taking a long time. I understand you guys are busy, but as long as you work with us, my goal is not just to get 2 months done, because 2 months is like almost very rare, right? So my thing is you apply in November and get it done by like February, before the next tax season really kick off. That would be the golden window to do this. We can do it together. We can accomplish it. Yeah. Okay. We can move on to the next question. Tim, very, very good question. That's not the only way you can donate to other charitable organizations. So that's one of the way, right? Am I understanding this question correctly, Jacob? He says that's the only way.
Yeah, I think that's what he's asking.
That's not the only way. Yeah. So
you could do like private charitable stuff yourself.
Yeah, you can do you can set up a scholarship yourself, right?
Mm-hmm.
Yeah. You can also, there's another thing for charitable organizations, you can donate to overseas organizations. But there is some complexities there. So making sure that overseas organization is a charitable organization, and how do you determine that? You might need a CPA to help you determine that, or you have really good documentation to show they are a charitable organization. So this is actually one thing Family Foundation is very good. If as a person, you really cannot do that. But as a foundation, you are capable to do that. You can do a lot of things with that. That's not the only way. Yes, Suraj, that's the formula. That's the success formula. And also, if, whoops, you contribute too much, let's say you contribute 21% stock and 11% cash, then what happened, Jacob?
You got me on this one.
I'm glad I get you on that one. It carries forward. You know it. It just
yeah.
Every time, let's say if you made $1 million and you contribute $210,000 in the stock, because when you decide to donate the stock, it was only 200,000, Suraj, and then it become 210,000 the next day. So the 10,000 will be carried forward to next year. It carried forward 5 years. Jacob actually knows it.
Yes, I know that one.
He's nervous. That's all. Okay, I hope we answer your question, Suraj. But that's a beautiful formula. That's what we tell most of our clients to do. Andrew, that's $1 million question. I love that question. So this is a question I get asked a lot. So Justine, do you think we should do it? And how much money people actually make, how much money they actually have before they think about this? There is no set answer. Like in our book of business, most people who hit the highest tax bracket will consider this as a very serious option. But doesn't mean only the people who hit the highest bracket. I've told you we've had people at even 30%, 32%, they are thinking about that. But very rarely there were people at 10% or 12% thinking about that, right? That's the fact of life. Mm-hmm. And also it goes together with a lot of other facts, what your objectives and goals. So when you have a question like this, I suggest you to schedule maybe a tax planning with us or with your own CPA. The tax planning is a piece, not only just how do we save tax today. So look at your situation. What's your income? What's your age? What's your family situation? And then what are your assets distributed right now? What do you want to do? Do you want to have an early retirement? Like, that's not what I want. I'm not joking in my office. I want to die working on my desk because I absolutely love what I do. And I don't work a lot of hours right now because Jacob works until 12. I don't. Jacob doesn't even work until 12, right?
No, I don't.
Yeah, you said you had a good tax season with us, right?
Yeah. This was very smooth compared to all my other ones. Like, it was great.
Yeah. So the thing is, maybe Jacob wants to retire at 45. Retire in this day doesn't mean you don't work. Just mean you're gonna go do things you want to do. So Andrew, I think you have a really, really good question. I'm sorry I can't answer that question. So if you want our help, set a time with me so we can look at all your situation, whether family foundation is a great tool for you. So I can give you something else. Again, Byron's not here, so I'm going to speak for him. So he actually set up the foundation with us 3 or 4 years. We didn't do much the first few years. And now he said he's so happy that he has this tool in his basket because he is seriously really worried about estate tax. Okay. He's going to pay. We're doing Excel. He's an Excel guy. We're going to pay so much tax in estate tax. He's like, I am so happy we have this tool that we can use.
Yeah, that's a great way to explain it. Another tool in the basket.
Yeah, it's not the only thing. It's not one for all, and it's not for everyone. You know, like I said, the charity, the philanthropy has to be a piece in it. And my other clients' point of like you really want to give. And another thing I used to say is so what's enough, right? How much is enough, right? Everyone's different, right? So, and also ownership and control. Really think about that. If you can have control of most of the things and you don't have ownership with, to some people, that's a great place to be. To some people, no. They want ownership, right?
Mm-hmm.
So again, no judgment here. Joyce, how are you? Thank you for joining this. I feel so happy that you're coming to my webinar. So yes, the tax return is a public information. So I don't have my clients that having any issues with that yet. Good question. You're thinking really ahead in the game. It's not really financial statement. It's your tax return. And I don't believe the donors are disclosed. I'm not sure. I know the grant recipients is I don't think, and most of the donors in my client's family foundation are from their family, sometimes sisters, brothers, mostly just from that family. So it's not like there are outside people will contribute. Yeah. I hope I answered your question, Joyce. And you can always call me. I'm one phone call away for you. Oh yes, Adele. Most definitely, you gotta pay the kids the fair wages, right? Don't make them into slave laborers, and really make them work for their money. I think teaching kids that is, my kids are older, so teaching them that they have to earn their money is really, really an important concept, especially for children coming from, I won't say just wealthy, just well-to-do, that they never have to worry about money, to understand the work itself. Work will bring you fulfillment, not just money, but that's how it goes. I still remember one of my clients said their daughter didn't want to work for their foundation because said, well, I'm not really doing the work, you're just giving me money. So I said, please make sure she works. Make her work for her money.
Yeah, and then multiple jobs would not be an issue in any way. Just like a kid could have multiple like work at an ice cream shop and the roller rink and that kind of thing.
Yeah. Just make sure you're paying her reasonably. You're not going to pay a kid $100,000, right? Mm-hmm. Just be fair about that one. Yeah.
Yeah, there's no way he's working full time in one job and full time in another, so it all comes with a little bit there.
The only time I see kids make a lot of money is modeling. So make sure that maybe your Tio should try that. Okay. Move on. These are very good questions, guys. I think all of you have been really thinking about this. This is lovely. So Liz, very good question. So if you are still working, making $1 million, you definitely should not pay yourself, right? You're right. It'd be really silly to do that. But there are times like people pay their children, which they don't have any other income, or when they are older, or when they no longer work, they are only working for the foundation. That's the time you should get paid fairly for your contribution. And so it's basically you're creating a job for yourself, right? Making sense? Jacob, is that making sense?
It wouldn't be cycling as much because you would have been in a higher tax bracket when you made the contributions compared to when you're retired and don't have any other income aside from the foundation doing that job. You will most likely be in a lower tax bracket then as well.
Yeah, and also I have another real life example I can give you, Liz. One of my clients, only one so far, they are winding down their foundation because their children are not that interested in their foundation. So, and they are in their late 50s, I believe, early 60s. So they are just still doing a lot of the contribution, but they're also paying themselves a fair wage. So they plan to maybe completely wind down when they're 65 years old. And then health insurance is a big consideration, because if you can get health insurance through an organization, a group insurance is always much better than individual insurance. Until 65, you get Medicare, right? So those are the small side benefit you get, okay? I believe the contribution they made was much bigger than all these little benefits they're gonna get, but there's still benefits. And then they're not really cycling money. You have different times. Jacob made a good point. When is it's almost like 401k, right, Jacob? You put in the money when your tax bracket is higher. When you retire, your tax bracket is lower, right? Yeah. In that way, it's similar. Yeah. Okay. Any other questions? Very good questions.
I see one that popped up that's asking, can you use your 401k money to fund the foundation? What's your thoughts on that?
You can, but I believe for 401k, you will have to take it out first, then put it in. So you still get the deduction. Then you cannot do it when you are less than 59 and a half, because there's a penalty you're paying, right? Then don't make sense. Yeah.
Yeah, I agree with that.
If you are older, yes, you can do that. I think if we don't have any questions, we're actually ahead of time today. So, right? Christy, we have no more questions? So everyone, thank you so much for coming to our webinar, and we close it up in good time. And hopefully you will have a conversation with Jacob or me if you have any questions. And hopefully this is helpful for you. And you can, again, check our webinars, other webinars. We have like real estate centric, how real estate is the best tax, best investment in the current tax code. We have a lot of webinar going. So if you guys can, watch them if you like them. I tell most people you don't have to watch them. You can just listen to them when you're cooking, when you're washing dishes, folding laundry, take a walk with your dog, because most of the concept is in the conversation, not really the PPT. So, okay. Bye-bye, everyone. Thank you for coming, right?